We have a private conversation.
Okay, Terry?
We're ready.
Morning.
Okay. I will call to order the subcommittee for audit of the overall fiscal affairs committee. We have one action item, which is, and I will move the approval of the minutes of the April 1st, 2013 meeting.
Second.
Any discussion, comments? All those in favor?
Aye.
Opposed? Abstentions? The motion carries. We have two information items. The first one will be presented by our auditors, KPMG. And for the second one, addressing the results of and recommendations emanating out of the request for proposals for auditors, we'll ask KPMG, obviously, where are they? There it is, Shelley, to step out. So on this one, I will turn it over to our relationship partner at KPMG, Shelley Massey, with the notation that this is a very fat PowerPoint.
It's very fat because there's an attachment at the end,
Okay.
which we're not going through.
Okay. Shelley, thank you. I turn it over to you.
Thanks, Peter.
We'll definitely read it all.
First, I believe the draft financial statements were included in your package.
Correct.
There were some changes to the presentation this year as a result of a new GASB standard that was adopted by the university. I think most of the changes are going to be addressed throughout the presentation. So hopefully I don't miss anything, but at the end, after I go through the PowerPoint, I'd be happy to take any questions on the financial statements. All right, so beginning on, I guess the second slide, the KPMG engagement team, I've included everybody who has a role in this year's audit, and it's broken out between the core engagement team and our other team members. The core engagement team did remain primarily consistent with the team members from last year. This is the team that is working day-to-day on the audit in the central office location. The other team members assist the core engagement team with specialty areas such as actuarial reviews and valuation reviews. On slides 3, 4, and 5, I'm not going to go into these in detail, but they do include the responsibilities for all of the different parties that have a role in the audit: management, the audit subcommittee, and KPMG. These responsibilities have remained consistent with the past, and the vast majority of them are also included in the engagement letter that is signed at the beginning of the audit. Just a couple of things to highlight. There was a new auditor's opinion that was included this year. It was a result of new AICPA standards. And the auditor's opinion, while it generally says the same thing, it was organized a little differently, and it now includes headers. And the headings above each paragraph let the reader know what's in the paragraph to follow. And there is actually a paragraph that's titled Management's Responsibilities, and there is a paragraph in the independent auditor's report that's titled Auditor's Responsibilities. So it's clear to the reader what's management and auditor's responsibilities when they read the opinion. Another change in the opinion is that the term unqualified, which you may have recognized as a clean audit opinion, is now the terminology to be used is unmodified. So you either have an unmodified opinion, which is good and clean, or a modified opinion. And if you have a modified opinion, it would be discussed in the opinion as to why it was modified. Again, just because of the AICPA standards, that was changed. On slide 5, so just a few things to point out for KPMG's responsibilities. Our primary objective in an audit is to form and express an opinion on the financial statements. And we do plan to issue an unmodified opinion for the university's 2013 financial statements. And this is a slight change. We always talk each year about the fact that I carve out the foundation auditors. We do not rely, or we do rely on the independent auditors' opinions for the foundations, and that has not changed. But one of the things that has changed as a result of GASB 61 is the discretely presented component units, which in the past were just the foundations. Now, because of the change in standards, includes the auxiliary corporations, the child care centers, and the student associations. So I'll go into that, the reasoning for that in a few slides. But because of that change, we still do audit and take responsibility for all of the other component units. So the child care centers, the student associations, and the auxiliary corporations are still audited by KPMG. So that you'll see some language in the opinion that's looking at the fact that we don't rely on 22 of the 73. So that's just some new language in the opinion. Okay. And then on slide 6, just to go through where we are as of today, we do have a few pending matters. The first is the final down-to-date procedures, which we will complete next week. The KPMG review of the final financial statements tie-out, that has been completed. It's going through manager and partner review. The tax review has been completed by our KPMG tax manager. It's just in the process of being reviewed by the tax partner. And we do have to review the GASB 39 memo that was prepared by management. I will be looking at that later this week. But I do believe that we will be in a position to issue final audited statements at some point next week.
What does tie-out mean?
Oh, it's when everything in the financial statement footnotes need to be agreed to supporting documentation. And also all of the numbers in all of the statements, we agree back to what we have audited. It ensures completeness of the financial statements in the sense that we have audited the numbers that are actually in your financial statements.
Thank you.
And I'm going to turn it over to John, who's going to walk through the audit results.
I'll just touch on slide 8, just to give an overview on some of the audit areas of focus. Again, your balance sheet, your statement of financial position is broken out between current and non-current. One of the key items there is that your net position, which is broken out between unrestricted, net investment in capital, and your restricted, which is broken out further between expendable and non-expendable. That information has remained relatively consistent with the prior year as far as formatting and presentation. We look at a host of things when we go through an audit, similar to what we've done in the past. We look at presentation of scholarship allowance, we look at the methodology and the presentation, whether it's shown as a discount or whether it's shown as a actual reduction in expense or an adjustment to expense. We look at your student receivables and loan receivable accounts. We look at the methodology to calculate any reserves that should be applied to those. We assess the aging of those receivables and assess whether there's any additional reserve that should be put on there. The methodology has remained consistent with the prior year and continues to be appropriate in the circumstance for 2013. The valuation of OPEB is something that's performed by a third-party actuary. We received the confirmation from the actuary. We involvement of our own internal actuaries to review the assumptions that are used for the calculation. We also performed certain test work over the census, and all those procedures were performed consistent with the prior year and appear reasonable in the circumstance. When you look at the valuation of investments, you have several alternative investments, and these are those investments that are approximate about $90 million, but they're not readily available investments, and you use a net asset value in order to ascertain their valuation at year end. We obtained these audited fund statements from the actual custodians and fund managers. Using that information, we perform certain procedures such as roll forwards, because typically they're valued as of 12/31, and we roll that information to June 30th. We perform confirmation procedures, and I think a good understanding is that the underlying investments that are rolling into these funds and alternatives are primarily invested in marketable equities and also in debt securities, which are typically liquid. Again, that methodology has remained consistent. When we turn to page 9, the university also has several swap agreements. These swap agreements are valued by third parties. We confirm those values with the counterparties. We involve specialists from KPMG to review the assumptions and valuation methodologies and the likes. And again, those were relatively consistent and appropriate in the circumstance for 2013. Capital assets, again, a large number. During the year of 2013, we capitalized about $544 million, primarily for new construction. We involved KPMG Albany team. that audits DASNY and also has information up there for certain procedures that are performed over certain editions, over the useful lives and information. And again, that procedure and that policy has been consistent with how we've approached this in the past as well, and the likes. As Shelley mentioned before, the tax review does occur. Our tax manager has been through the process, just pending final partner review of the assessment. We review things for continuing to meet your tax exempt status, and also to see if there's any unrelated business income tax or tax exposure items that are there. At this point, I don't believe there are any, but we are in the process of finalizing that. And then finally, as is becoming more and more prevalent, review of information system is something that needs to be considered as we go through the process. We involve certain specialists that review your IT system. Any new changes with a focus on change management or program development as you move forward, especially since we're moving forward with the CUNY First system. That involvement has been there in the past and has continued into the current year as well. The final slide on page 10, I'm pleased to report that there were no uncorrected or corrected misstatements identified during the audit this year. It's a big blank page that says very good news. So I think that's an attestament to management staff and our ability to prepare the financial statements. So, turn it back to Shelley.
Okay. All right, on slide 11, this walks us through some of the changes to the financial statements as a result of the university's adoption of GASB 61. This amends two previous GASB statements, number 14 and number 34. So this really looks at the university's component units and whether or not they should be presented in what's called a blended presentation, which means it would be in the university's column, or a discretely presented presentation, which is a separate column or a separate page. And we reviewed the student associations, auxiliary corporations, and child care centers. We also did review CUCF and RF CUNY as well. So RF CUNY and CUCF do remain blended, while the other ones were changed to a discrete presentation. And there are a lot of different factors that we consider, but the primary reason why the student associations and auxiliary corporations and the child care centers were moved from a blended to a discrete presentation is because to remain blended, that entity needs to be providing services to the university or exclusively benefiting the university and not the constituents, so not any of the students or anybody on the campus community. So for those organizations where they were found to be benefiting and providing services to the students as well, that is the main reason why those entities have moved to a discrete presentation. So something that you're going to see on the balance sheet is we used to have a 2-page presentation showing the university on one page for the statement of net position and the discretely presented foundations on a separate page. That presentation was changed this year to a 2-column presentation. So you'll notice on the statement of net position that the university is in one column, and that does include RF CUNY and CUCF, and then all of the discretely presented component units are in a second column. So one key thing that the university did and that we looked at was while the student associations, auxiliary corporations, and the child care centers are GASB organizations, the foundations are not. They present their financial statements in accordance with FASB. But to present the financial statements in the 2-column approach, we can change the presentation of the foundation statements from a FASB to a GASB format. The two main differences are that in a FASB presentation, you do not have a classified balance sheet, which means that you do not have separation between current and non-current assets and liabilities. So when the university was reviewing the foundation statements, they went through the financial statements and the notes of all of the foundations to disaggregate the assets and liabilities into this classified format. And that was something that we reviewed as well to ensure that all of the 22 foundations were appropriately presented. Also, the equity of a FASB organization and a GASB organization differ. The FASB organizations display their equity in unrestricted, temporarily restricted, and permanently restricted, And GASB's, while the classifications are similar in nature, they're called something different. So we looked at management's analysis to take all of the FASB equity from the foundations and classify it into the GASB presentation. So I think it's a really clean look at the financial position of the university. Everything is on one page, and there is a total column that displays the total net position of the university and all of the discretely presented component units. So for the first time, the foundations are actually in that total presentation. And that is the approach that was taken for both the statement of net position and the statement of changes. The cash flow has and does continue to be just a university cash flow. The GASB financial statements do not require the discretely presented component units to present a cash flow.
So that means none of the income, interest income from the foundation showed up in the cash flow statement?
Not in the cash flow, correct?
Thank you.
Okay.
Couldn't figure that out.
There was also, one other thing that I will note about GASB 61 is there was a new requirement for disclosure of the blended component unit companies to be broken out separately from the university. So note 16 displays a kind of like a combining statement of the statement of net position, the statement of changes, and the statement of cash flow that shows a university-only column plus the RF CUNY plus CUCF, any eliminations that then rolls up to the face of the statement. So this provides the users of the financial statements some inside information into the blended component units and what the activity of those blended component units is in comparison to the university only. Any questions on that?
Just one, I mean, on page 18 of the statements, so I'm looking at the statement of revenue, expenses, and changes in net position. Investment income there includes all of the foundations, whereas on the cash flow statement, the next statement, they do not, correct?
Exactly, right. So the 42 million in the discretely presented column would be primarily for the foundations,
Right.
but it would also include the other discretely presented component units as well. Oh, I guess one thing that I should point out, as a result of the change between blended and discrete presentation for the student corporations, auxiliary corporations, student associations, and child care centers, we did restate opening equity. So the equity for those entities that was previously in the university column as blended was moved to the discrete presentation. So there's a reduction of approximately $42 million of equity from the university column that was added to the discretely presented column. So in total, there was no change, but the presentation of where that equity belongs did change. And that restatement is noted in a paragraph in the opinion. No questions with that? I'll move on. Okay. Slide 12 discusses all the reports and deliverables that we will be issuing for CUNY this year. So today we are reporting on the university's financial statements. In future meetings, and generally the one included in February, we discuss the remaining reports, and we issue a senior college only set of financial statements for the purposes of the state of New York. We issue a federal OMB A133 audit report, which is primarily on the student financial assistance that the university receives. And we will also issue a management letter. And the work for all of these reports has been complete. We're in the stages of review and drafting of financials. Slide 13 includes all of the other remaining matters that we're required to discuss with you today in accordance with the auditing standards. There's a lot of nones and nothing to report, which is all good news. We discuss a lot of these issues with management. We do confirmation procedures, and we review minutes to ensure that there is nothing to report. No matters to report with going concern. No significant pending litigation that was required to be separately disclosed within your financial statements. We did not identify any illegal acts or fraud or noncompliance with laws or regulations that we needed to discuss with you. There were no difficulties encountered in performing our audit, no disagreements with management as we conducted the audit, no consultation with other accountants that we're aware of, no significant issues that were discussed prior to our retention as auditors for this year, and there were no significant changes to our planned audit scope. Slide 14 includes the fraud risks that we need to consider. So auditing standards requires us to consider these fraud risks for all financial statement audits. The first is fraudulent misstatement of revenue recognition. We do a lot of control test work to understand that the transactions are being recorded properly, and the primary substantive procedure is we review cash receipts that come in at or near year end. So we are looking at the cash receipts and determining what period they were being paid for. So if it was a previous semester, they would be recorded as revenue. If it was for a future semester, it would be recorded as deferred revenue. And we did not have any exceptions in that test work. The second fraud risk that we consider is the risk of management override of controls. And in this area, we review all the significant accounting estimates. These are areas where entries are generally booked manually through journal entries to increase or decrease reserves. And we do look at all post-closing entries from the point where we audited the numbers to the point where they have been agreed to the financial statements to ensure that nothing was changed subsequent to us doing some audit work and the issuance of the financial statements. Slide 15
Before we move on,
includes...
I have a question. I think it's probably directed to Miriam. Miriam, in the last audit, we had an issue regarding a dispute with the Department of Education. Would that be cognizable under this, or, well, let me just ask you, has it been resolved?
Yes.
Okay.
It was absolutely resolved.
All right.
All right, that was on the programs that were not in compliance with the filings and the pieces, and
Right.
we were worried about our exposure. For some of those programs, we absorbed some of the costs. They're mostly certificate programs. For all of them, the schools filed the necessary paperwork and the pieces, and we were among many colleges and universities who had similar issues, and the Federal Department of Education really sort of backed off doing anything, and we got word that everything was fine and we should just go ahead.
Great.
So, yes.
All right.
I'm glad you remembered and asked. Thank you.
All right, slide 15 includes the material written communications between us and management, and they include the engagement letter, which sets the scope and fees of the engagement, which is signed by management prior to us beginning the audit, the in-house legal counsel letter, the management representation letter, and the management letters. And on slide 16, we're required to report to you that we are considered to be independent with the university. This is something that we do monitor very closely at KPMG. We have many systems in place to monitor any other services that we would be providing to you to ensure that they would be considered independent when we perform audit services. But during the past year, we did not perform any management advisory services for the university. Slide 17 includes two new accounting pronouncements that the university will be required to adopt in one of the next 2 years. And I actually have these in flipped order, but we'll take GASB 68 first, since it's the first one on the slide. It is effective, though, 2 years out for the university's June 30th, 2015 financial statements. And this does establish new accounting and reporting requirements for governments that provide pensions to their employees. And it will require, most likely, that the university will have to pick up an additional liability for their portion of the net liability of the plans that they participate in. So the university participates in the ERS and the TRS plans, which are multi-employer cost-sharing plans. And once those plans go through their adoption of a new standard, there is another standard 67 that the pension plans are adopting this year, 2014. And then once those plans are being valued, then the university will have some sense as to whether or not what the incremental liability would be.
You don't know what the amount is, order of magnitude in terms of the,
Big.
No, not currently. I think we'll have a better sense 1 year from today.
so there's nothing that we can do to plan or accrue for it, or?
No, because I think what 67 does is these pension plans will have to go in and it looks at the assumptions that they're using and how they're calculating the liability. Once they take that and have their actuaries work their magic, that's when they'll have a number that they'll know if there's any amount that needs to be passed down at that point. But until they go through their calculation and assumptions, it's really kind of impossible to tell at this
So
point.
there's no way that we could accrue for it just to mitigate the risk in 2 years?
No, I mean, and plus the way that the pronouncement is worded, that you would not be able to pick up the liability until you actually
Okay.
adopted
Yeah.
the standard, right? The other new standard that's included here is GASB 70, and it is effective for the university next year. And it does establish new accounting and reporting requirements for governments that extend a non-exchange financial guarantee. And there are a few instances, I think 2 instances, where the university is guaranteeing debt of a component unit. So we will need to consider whether or not there's any factors that are triggered that would require the university to record a liability for that guarantee.
What I'm willing to put down.
Would that be for the full amount of the guarantee or for some probabilistic amount?
Yes, it is a present value calculation, so there would be some assumptions made on what the future payments would be, and then you would discount it back to present value to today.
And you
But it
wouldn't,
only does require the university to record that liability if there are certain factors that are triggered. So unless that organization has filed for bankruptcy or has missed a payment or they're in some financial distress where the university does believe that they will have to make a payment, that's when the liability is recorded. If none of those factors are triggered, there is no liability to be recorded. It is just a disclosure, and those 2 guarantees are currently already disclosed in the
right.
financial statements.
And those guarantees are for operating units of the university?
Yes. They are,
we
both of them
assume
are
that if-
discreetly presented.
If the operating unit goes bankrupt, the rest of us are going in the same place? Right, okay, got it.
Yes, I don't believe that the university feels that they will ever have to make a payment.
Those dorms better fill up. I'm told Staten Island is totally full, which in their first year is pretty amazing. So they're pretty pleased, and I'm pretty pleased.
That really does conclude the presentation. I did include just a couple of high-level slides for you that highlight some of the things that were included in our 2013 higher education survey. So that is included in the back of the presentation. So for your reading pleasure, I think it has a lot of great information, and a lot of clients are, realizing that as they go through that survey, that the issues that they are encountering are really found, all throughout the United States. And the survey does break out some of the questions between private and public. So there are some differences in some of the risks between a public university and a private.
Is there anything in here that's particularly pertinent that we read through all of it, but just for
I mean, I
public
think
consumption?
the two things that I was noticing as I was visiting all of my higher education clients is that, and the first one may be a little bit different for you, but most of my clients are very concerned about their enrollment levels. And we did see a significant spike across the nation from 60% of university senior management were concerned about that last year, but that has increased to 71% this year. Now, I know from talking with many of you that your enrollment has remained consistent or even maybe gone down slightly, but not an overall concern for CUNY. The second thing that I have noted, and a lot of my universities are doing some very unique things, to retain enrollment numbers, they are really looking very closely at some innovative strategies to increase their numbers. Looking at, one of my schools in New Jersey is looking to become almost a 50% international school, because they can bring in students internationally that will pay a higher tuition rate and not need as much of a discount. They are looking very closely at their programs and their academic programs that have, less number of students, whether or not they want to continue those programs, and eventually weed out those. So they're I think the higher education industry is really going through a change right now, and they're looking at a lot of different ways to be able to keep up their enrollment numbers. There's a lot of competition, from private schools. A lot of people are moving to public universities because of the tuition rate.
Is that it? I'd like to open it up for questions of members of the committee and staff.
All right, I've got, under the general area of continuous improvement, each year this gets better, cleaner, easy to read, easy to understand, and that's a great positive. I would suggest, for example, that the MD&A, we have economic factors that may affect the future. That's getting close to the idea of risk factors that you would see in a typical presentation. I think that is a step in the right direction and perhaps could be elaborated on it a little bit. We talk about the different policy. There's no mention of demographics. Just some of the stuff that we would just discussed might make it back into the MD&A. And then two mild concerns. Again, under the idea of continuous improvement. This is a big document. Sorry, give me a second.
Take time.
I will find it. Oh, here it is. Okay, on page 33, under some footnote, section 3A, the last sentence says the university's cash management policy does not address custodial credit risk for deposits. I think that should be fixed. We ought to be looking at the credit exposure of the banks where we keep our money. That's not so difficult to do, and it's just a risk factor that we ought to deal with. And similarly, back in the back someplace here, I guess on page 47, it appears that we have the same issue with DASNY. We don't know the credit characteristics of where the $426 million that apparently is ours, where that is held. I'm not expecting in either case that there's an issue, but just good risk management would suggest there be a process by which we looked at that and satisfied ourselves that we could look at their credit default swap ratings. It's easy to do, just so that it doesn't look like there's no process. So if something, God forbid, went wrong, we would look like we had a hole in our risk management processes.
I think two excellent points, Trustee Martell. Thank you. Anything else from that end? I would like to note that this is our student trustee, Mohammed Arshad's first audit committee. And for the record, he has his bachelor's degree is in chemical engineering, but he's getting a master's in public administration. So my question is, after hearing this absolutely fascinating audit report, you rethinking chemical engineering again?
No, it was a great presentation. Thank you.
Is that it then? Yes.
I have,
Sorry,
Please.
Vice Chair Barry?
no, it's going to be pertinent, Trustee Pantaleo, to a discussion that we'll have later. And I was looking at this issue concerning the annual compensation as a top factor in attracting and attraction and retention. Is there anything that you can elaborate on regarding that in terms of that particular trend and what colleges are doing differently?
I mean, colleges are trying to look at the overall, compensation packages that they're providing the university faculty. I just know that from the colleges that I work with, it is a struggle to, balance, what they need to be paying faculty to retain good people, and what their cost structures have been doing over the past few years. So I just know it's a balancing effort that they're trying to focus on right now. But over the years, the universities have really been trying to retain their costs, And I think they've gotten to the point where they can no longer do that, and that's why they're really focusing on the revenue side now. But it is very competitive, and they're looking at different ways to, enhance their overall package for faculty.
And I assume faculty and as well as administrators and staff.
Yeah, I think that was more on the faculty side, though.
It was more in the faculty.
Yeah. That piece.
I think there's, I think that's a risk factor for us.
I was going to say the same thing,
Right.
Terry.
I think it's a risk factor.
I think, what you don't know, because your audit wouldn't reveal it, and it's not for here today, but the reality of it is, in every survey, for a system of this size, our faculty as well as administrative staff are materially below the norm. And I think, as Professor Martell just indicated, it is appropriate area of concern for the board, because I do think it presents as, and I agree with his term completely, a risk factor going forward. Vice Chancellor?
Going to close. When I look at my calendar each week, I divide it between meetings that are real grief and just annoying. And this has, we have every reason to expect this meeting will be real grief, generally, and it's not. So I just want to take the time to thank Mark and Matt and Len and Miriam and Tom for the great work you do all year to end us in this place.
I would certainly concur in that, and although I've never heard anyone congratulate you for merely being annoying.
My life.
Welcome to government.
I'd like to just underscore that for the record. I mean, it's an excellent presentation, and also the portrayal of the facts and the issues. A very, very good job there.
Thank you.
Which is a perfect segue for the next segment of our meeting, which we would ask you to excuse
Okay.
yourselves to discuss the audit contract.
All right, thank you.
Thank you.
As always, thank you.
Thanks, guys. We'll be in touch.
We'll be in touch.
Sorry? Good. Might be behind time.
Is the risk factor having a labor union?
Great shape.
Wow. You notice my comments are always limited strictly to the
Enjoy,
Read, that's the
I
thing, so
caught
you
that.
Shelley and John, enjoy your holiday.
Hey. Exactly. No. Thanks again. Thank you, Sean. Who's going to lead the discussion? I guess Matt. Or Matt or Matt. That's it. Okay. The next item on our agenda, and is obviously the reason we asked our KPMG colleagues to leave, is approval of the request for proposal recommendation of an auditing firm for fiscal year 2014 through 2019. I call on Vice Chancellor Sapienza.
Thanks, Chair Pantaleo. The contract that we have with our external audit KPMG is expiring, and so we needed to start the process of procuring services going forward for external auditing. We put out an RFP out on the street. We put together a review committee, as we do with most large procurements. The review committee consisted of folks from central office and college financial managers. We received several submissions from outside audit firms, reviewed them, came down to a few finalists, and what we'd like to recommend today to the committee is to retain KPMG as our external auditor going forward. We think not only with their pricing proposal that came in was extremely competitive and doesn't increase the costs that we currently have in our contract for external auditing, but also their experience not only in the higher ed sector, but in GASB, we think makes them the best selection out of all the proposals that we received. So we'd like to make the recommendation to the audit committee today. The formal vote on the contract will be done at the January Fiscal Affairs Committee meeting. But we'd like to make the recommendation to the audit committee today and make sure that there were no concerns or questions that may come up in advance of the fiscal committee meeting in about a month.
Okay. I just have, I'll start off the question, obviously a question I think needs to, I'm sure the right processes were followed, but I think it should be stated on the record. Did we have several bidders for this, and they were all evaluated by whom?
We had 8 bidders, and they were evaluated by a group that consisted of one of our colleagues, Ken Torino, who works on the audit from the central office, We had representatives from John Jay, Hunter, and, you gotta help me on the last one. An internal audit.
Hostos.
Hostos.
Okay.
All right? And they reviewed all of the written proposals that we had, and they scored them according to a score sheet that looked both at experience and dollars and cents and expertise and pieces. And then from there, we came to the 3 top firms who came in and did presentations for both the whole committee and some of the rest of us who came to listen. And then the committee sat down and deliberated based on that, using a scoring process again, and came to the conclusion that KPMG was clearly the best choice, mostly around their skill and experience in the combination of GASB and higher ed. And part of this is a reflection of the fact that in New York State, there are only 2 GASB higher ed institutions, that's SUNY and CUNY. And I think it's interesting to point out that KPMG is auditing both SUNY and CUNY. It's a little different in New Jersey, because in New Jersey, many of the public universities, all of them have separate audits, which is where KPMG is able to get a fair amount of experience, because they do a number of them. But the other firms that made the finalist could talk about doing some of it, but not within the New York offices. And that was really important to us, that we had a firm who could help us think through when we had new GASBs to put in, and making sure we were in a consistent presentation.
That's very thorough, thank you. I just wanted to be on the record as the process that was filed. I have one other question, which is, it is my understanding that accounting firms, auditing firms, follow a procedure about rotating out relationship partners and the audits, and I assume that would be done here in order to preserve avoid the sort of natural human affinity that occurs by working closely with people.
The KPMG's policy is 10 years, and we've had some conversation with Shelley as to when she would need to rotate out. And we would like to make sure there is continuity on the team. And John this is his 2nd year on the job, and we've seen some rotation below that, but also been able to have some continuity. Right? We appreciate the continuity in the folk that come, because they at least know where to ask for something and what they're asking for. And it's been a little bit of a juggle as we shift systems. So not only do we have to make sure we can produce something that's different, they have to look at it as well, and it's different. It's different than it was last year.
But as the frontline consumer of this particular service from the accounting firm, Miriam, your department is happy with this recommendation?
Very.
Okay.
And I'm looking at Thomas and Ken, because we all deal with them.
That's great,
Yes.
thank you. Professor Martell?
Just a process question. When you said the frontline consumer of this, we're the frontline consumer of this.
Correct, the audit committee, but before us,
I understand.
it's the controller's office.
And typically, although I'm perfectly comfortable with the recommendation, an audit committee would have a more significant role in the vetting of the selection, so that what we have here is a recommendation, which I'm happy to accept, but a little bit, from my experience, a little bit of a difference in terms of the process by which we get to that point. And that's just for general information.
I think that is a fair comment, but for my perspective, I would just like to stress one thing, and that is, unlike the normal situation, we are, whether we could say blessed or inhibited by the New York procurement laws and the rest. Having the independent trustees involved, for example, that would have been an inordinate complication for me and any professional service provider, because we all do work for the varying accounting firms.
I understand.
In this case, I don't vote, just by way of example, on the trustee, on the auditor, for the reason that my law firm represents virtually all of the big accounting firms for accounting malpractice, things like that. So I don't necessarily see a conflict when if one is happy, 3 are going to be unhappy.
Right.
So, but I do think that the New York procurement law, and I will defer to Vice Chancellor, obviously, Vice Chancellor Schaefer on this, but I think we have probably the best practice we can have consistent with the realities of public procurement. Rick, do you have anything to add to that? Okay. Any other questions, comments? Okay, we don't have an action item on this. You have in your package the resolution that will be presented to the board. I assume it will be presented to the board with simply with the comment that it was considered by and passed on by the audit committee, but we don't need a formal resolution on that, correct, Jack?
And it'll come up at the Fiscal Affairs Committee.
Oh, then they will make the
Yeah, in
In
recommendation.
January, that's when it'll
Okay.
formally come up.
Thank you. Any other business? To have a motion to adjourn?
So moved.
Excellent. Adjourned. Thank you.